Hey everybody, this is Jose. How are you, everybody? We are about to get started in 1 minute. Let's use this time for a quick sound check, as we always do. A quick message on the chat box would help me to know that you hear me well, sound is good, we are ready to get started. And it's, as always, a very nice way to start the session by having you guys say hi to everyone. So please do that, and we'll start in 40 seconds. Thank you so much, everybody. Just a little bit, and we get started. Thank you so much. Thank you, Joe. This is appreciated. Thank you so much. 15 seconds to go, and we start right now. Here we go. Perfect. Mark, how are you, my friend? Good to see you. Welcome, everybody, to the session. Today is March 17, 2022. This is Options with Options. We're going to be looking at the options markets. I guess the name of the session kind of says it all. Options give you options, so we often employ different type of strategies depending on the market conditions and what the market has to offer. So we try to be adaptable, position ourselves with the right strategies to maximize the efficiency of the opportunities that we find and also minimize the risk, which is obviously something that we focus very much on. Before we get started with the session, I would like to highlight the disclaimer on the upper left side of your screen. Please read it carefully. This is important information. As I always say, it's fairly short. So I'm counting on you guys to read it completely. Do not skip it. Again, it's important stuff. With that said, the plan for today, as always, very mechanical approach. We're going to be looking at the market. We're going to be looking at trades that we have, review such trades, see if any trade management action needs to be taken, and from there, moving to looking for new opportunities in the market. That's the plan. So that's it. I'm just going to close this PowerPoint presentation. Also, before, let me see. Yes, perfect. So let's get started. I will just say it. How are you, Christian? Good to see you. I will just highlight the direct link, even though I don't have the web page ready, so I'll skip it just to save a little bit of time, but I will highlight on the screen the link for you to get to the question page, which is a page where you may want to search for answers out of prior questions that have been posted and prior answers that have been responded. Also, if you have a question that is not part of the list, you can certainly add your questions and then get answers, using that URL, tradewithufos.com/my name, Jose, or, any other of the instructors as well. Cool. With all of this said, we are gonna now begin our market analysis and go for it. And maybe, if you don't mind, so just so I don't forget, a couple of things before we get started. So we have a new version of Top that we are gonna release very, very soon. Okay, we've been doing some final tests and everything seems to be the way it needs to be. I'm talking about the risk graph. When we use to take trades, compare spreads, and do adjustments, and next thing you know, the risk values that we would have on the screen on the upper left corner were at times not coinciding with the risk and the reward values from the right side. So just for you to know, guys, this has been fixed, and in a future release that is supposed to happen anytime, again, we're doing those final tests, but again, we found a proper solution to the challenge, and therefore you'll have out there soon a version that hopefully very likely will make you a bit happier from that end. Okay, so that's has been done, and I want to thank you very much, guys, because this has been done as well thanks to your feedback. You guys are taking trading very seriously, and therefore you are looking at all those very important, sometimes very tiny details, very important and very appreciated, guys, that you guys gave feedback and help us to just keep improving what we do. Okay, so please keep doing that because that's what we're aiming for. Okay, cool. The other thing I wanted to also comment is on the web page that I shared with you the other day, guys. That was, let me put it on the chat box one more time. I'll grab it here very quick so that way I make no mistake. I'm talking about the stock tweet trading room that we have created. So I'm just posting it here on the chat box. Okay. A couple of you have done a couple of posts. I haven't seen much more activity than a couple of posts. But again, with that said, maybe the reason why there is no more activity is because you guys took a look and you're like, I don't like it at all. So fair enough if that's the case. Again, what I would like to gather from you guys, if possible, throughout the session, you can type it anytime. It doesn't need to be right now immediately. But if you have anything to share when it comes to that page and how helpful you feel it is, let me know. And if you feel it is not helpful and you are looking for some other type of tool, please give me more details, okay, as we are looking to implement a valid solution for you guys. Okay, with all of this said, so I don't forget, let's now focus on our market analysis so we can understand better what's happening in the markets, because the markets obviously are not a joke. In the past few weeks, a few months even, you can see the VIX has been going down. The VIX is currently trading 2691. So in one hand, you could think or expect that everything is going back to normal. The VIX is going down. Well, again, a VIX of 26, if you look at the history of VIX, is actually quite high. Of course, there have been times where the VIX peaked all the way to 80s and 70s and 90s. Well, obviously, 2010 is very little, but those peaks of such high values are in situations which are extraordinary, such as 2008, beginning of a pandemic, things of that sort. So right now, with a VIX of 26, we need to understand that there is still a decent amount of premium, a decent amount of volatility built in the options prices. And this is certainly useful if we focus on being a seller of options. So we'll talk about it as we do our market analysis, because in the past few weeks, and let's go back to the S&P, in the past few weeks, we've been talking about consistent contradictions here when looking at auto climate and the volatility comparison chart, consistent contradictions that basically we had indications to be a buyer, but then the options data would show us it was time to be a seller, or we had indications to be a sellers, but then options data would indicate being a buyer may make sense. And or just like today, for example, indications which are blue, but it's a thin dot, meaning the climate is not confirmed. So we are running this for a while now. I would say at least since kind of like middle of January or something like that. It's been difficult to get climates which match the statistical values. To the downside, we've been in most cases surpassing 3. And to the upside, in most cases, we have not reached 6, which is a normal thing based on statistics. So in other words, and by the way, this has happened as options data were suggesting that was going to happen, that climate was going to either not to evolve or the climate was going to last for longer. So again, great analysis, great tools. Thank you very much, tools. But at the same time, big challenge for trading, because we had very, very few situations where everything was confirmed, and therefore we were happy to take a serious bet in a specific direction, either long or short. So we had times in the past few weeks where we had these type of challenges, which again we have today with the non-confirmed climate, isn't it? And we had cases of volatility relatively low. That's when we did double calendars, which have worked very well. We're going to review those trades in a moment. And we also had trades like, I believe we have a Caterpillar, if I'm not mistaken, which is an iron Condor, where we have been selling premium when premium was higher. And again, collecting all that overpriced premium and basically position ourselves to be more non-directional than directional, because again, there was not a clear directional definition. So we are in a very similar situation today. I mean, many people may see, the current rally of 2 days and 2 days, 2 days and a half, if you wish, as relief, and everything is coming back to normal. This coincides with the Fed yesterday finally revealing they were going to raise interest rates, and everybody's like, okay, that's it, the market is back to normal now. Well, yeah, or no, or yes or no, because if you look at those moves here, they were way more significant, and that led to then a red climate and on lack of definition like we have now. So again, we still don't know what we don't know. We still have a big contradiction in front of us with a non-confirmed climate, And even if it was confirmed, the implied volatility for the puts as an average is clearly above the implied volatility for the calls. How are you, Jeff? Good to see you. So all of this is indeed the sign of a big fight, and there are reasons for that. Okay, of course, we are all thinking about the conflict between Ukraine and Russia and the world, because so many countries are limiting Russia on bank transactions and all sorts of things. That in the end is a worldwide conflict at many levels. At least in the financial markets, is a worldwide effect, and there is a reason behind why this is happening. But again, as a trader, it doesn't even matter if there is a reason or not. What we need to do is always position ourselves in a way where our positions are smart, and in case of wrong, the risk is well under control and we have the tools. So that's what we're doing. And today, this market analysis, which I want to go just a bit deeper I just want to take a look at a couple of more things. But basically, this market analysis is telling us that today the plan is to continue doing iron condors, continue trading non-directionally, and unless you have a portfolio already with a collection of positions pointing in a certain direction, let's say you have been reaching a few targets of some of the long opportunities, for example, with the recent rally, so then it would be time to either enter more longs to not to be too short, or enter some hedges if you are too either long or short, because again, there is a lack of definition from a directional point of view, and if you have directional positions in your account, you need to be hedged in some form, not fully hedged, but at least have a little bit of a hedging spice, if you wish, in your account, in case the market was to move aggressively in the opposite direction that you wish. Okay, so keep that in mind. There is still lack of definition, so caution is to be exercised. So notice in the intraday session for today, 1.1 time more calls than puts, 1.7 times more calls than puts, 1.7, 1.2. So it looks like we got a little bit more call trading than put trading. But while that's the case, implied volatility for the puts real time, okay, because on the left I got the 3-day average, but on the right is the real time, it's not an average. So the puts are above the calls, meaning that there are more calls traded than puts, but they are being sold. They are not being bought, they are being sold, which is a bearish thing. So while the market is going higher, at least in the last 3 days, while the climate is showing a blue dot, even though it's not confirmed, options data is suggesting that there is a little bit of a bearish component kicking in, and it's to be respected. We've seen it before, and we better respect it, because we've seen it before that often options data leads to candlestick or bar data on the charts to kind of react to it, and we see something happening in the options arena. Next thing you know, the price movement of the underlying follows, and often there is a reason for it, which is the fact that the very large market players often are very heavily positioned with options, and therefore whatever happening in the options is actually kind of like representing what the institutions or the institutional actions happen to be in the equities, if you wish, in the underlying assets. So long story short, not so short, careful. Okay, guys, always, I mean, we are always careful as traders, we're always managing risk and so on, but again, such continuous lack of definition, continuous contradiction on the market data that we are receiving implies that there is a major fight to the upside, to the downside, and cases like that is very difficult to predict if the market is going to move in one direction or another, or when. So options gives us options. That's not a problem, especially when the VIX is high, like it is now. So we can work on those non-directional trades. Okay, so if you have any question to my comment here, or you want to add more to what I just said, or you have a different view and you would like to consult, contrast, comment, go for it, guys. I am leading the session, obviously, but this is teamwork, my friends. So feel free to interact and work with me on that. That would actually be very appreciated. Mark, I didn't know when anyone would be there at the Stock Tweet page. Yeah, so I guess that because the Stock Tweet page is more like a little bit of like, let's call it a forum type of collaboration tool. So the idea is that you guys don't need to be online at the same time. So you guys post and others will see. Also, if you install the Stock Tweets app on your phone, for example, you can set it up in a way where you get push alerts and things like that. So when someone is messaging on that particular group, so you can get alerts, and basically you can react to that quickly. Okay. Christian tweets, somebody needs to start a discussion on a topic of relevance. Wage, got you. Okay, I understand. Yeah, and the question is, do you guys feel like this is the right tool to start a topic of relevance? Because again, maybe no one is starting the topic because you feel it's not the right tool. Okay, so right now, more than the content, my concern is that the type of tool you would like to use, or would you like me to look into other possibilities? And once we get that framework in place and you guys are happy with the tool, so then let's throw out there topics and trades and screenshots and whatever it is, so you guys can have a powerful conversation, and for sure we'll be around as well to support it. Christian, wedge forming on the SPY, what does that mean? Okay, so first of all, let's take a look at the wedge. Yes, so I see what you mean from a technical analysis point of view. So uh, so we could do a little bit of a drawing here. So we got price going down like this, and then we got price going up like that. So typically, from a technical analysis point of view, if I was to become a classical technical analyst, so typically when a structure of this sort is being formed, and you have a clause above, either above or below, I should say a clause outside, like it seems that it happened yesterday. So typically this would be seen as a breakout, and the expectation would be a change of trend, a continuation, and therefore a move of that sort. Okay, so that would be a very usual interpretation of there. At the same time, I'm not really a fan. While though all those patterns make a lot of sense from a market psychology point of view, to me there is something on top of it, which is the fact that just a little higher at 446, we got sell on field orders. So you may have this breakout of the wedge, it goes up, and next thing you know, when it comes here, now it's just going to retrace so much that it never gave that particular opportunity for the market to break out and create a new uptrend, unless on the way out, as the wedge is being is breaking out. So unless now you have multiple new UFOs that show up, okay, the green ones, because if that was to be the case, and now the market retraces down, comes into one of those UFOs, and now it's going to continue. But if you don't see those green UFOs showing up, so far the UFOs are way below the breakout of the wedge. So then that implies a pretty difficult struggle for the breakout to be efficient the way it would be defined from a technical analysis point of view. So to me, again, beyond chart patterns, which again are very intelligent ways to think of the markets, especially from a market psychology point of view, but beyond that, to me, I love to overlay, of course, the UFOs, because of the order flow. It's in the end is the key, but also the climate and the options data is going to also reveal if whatever is about to happen in the market has any sort of a likelihood from a statistic point of view to continue. Like in this case, for sure, if the climate was confirmed, 2 out of 6 certainly could generate a very powerful breakout, indeed. Okay, but the problem is that the climate being non-confirmed and the impliability of the call being lower than the put. So then I would say probably not. Okay, so in this case, you will now see a technical chart pattern fell, and many analysts would be like, okay, well, it just fell. We don't know why, but it fell. It failed. Well, my thinking, and of course I don't know for sure either, that would be amazing, but my thinking with additional market data beyond what you see on the candles would be like, well, from behind the scenes on the options world, we didn't have support of that movement on the underlying asset. Plus, on top of that, the climate was not confirmed, meaning that there was no indication of an impulse move. Remember, when the climate is confirmed, if you recall, we had lessons on that, a long time ago. Also, if you have taken our courses, we have plenty of lessons on that concept. But when the climate is confirmed, it means that we are having price movement, which is impulsive in a specific direction and corrective on the opposite direction. Well, right now, it's either impulsing up and impulsing down at the same time, or is correcting up and correcting down at the same time, meaning that there is not a price action that implies the potential for a trend to evolve. And in that sense, the breakout of a wedge would be expected to fail, even though magic, that one may work, but again, odds are against it. Okay. Christian, I like the tweet tools, but without content, we can see how it will work. Okay, got it. Got it. Perfect. Okay, so if I can get a bit more feedback from that, that would be great. Jeff, Mark, Joe, if you could also comment on the tool, and guys, feel free to just say I don't like it. It's fine. Okay, I just want to make sure that whatever we start using is something you like. Okay, and if you need more time to check, it's also fine. But just let me know. And certainly, I get your point, Christian. So as I get more confirmation from the community, happy to be the one that initiate a little bit of topics and screenshots and stuff just to get the trading room started. As you guys confirm, this is what you want to do. Anyway, trade review, positions. It's like a top session without trading content. Got you. I get your mindset. You make a lot of sense, Christian. Anyway, so WPM, this trade is over. Okay, so this trade is over. It made $125. Let me reset this to the midpoint. It made $125 per contract at the end overall. That's what the trade made. Remember, WPM was a double calendar. Love to know if you guys were in the trade. I know a bunch of you were. But anyway, so basically, if we go back to this trade, earnings took place on that particular day. Out of earnings, the stock ended up gapping down. But anyway, when the stock closed on that Friday, it closed at 48, which was higher than 45. Remember, we were long the 44 and short the 45. Therefore, our double calendar ended up making the maximum profit possible out of the last adjustment that we did. Which was $125 per contract. So if you were in this trade, I guess it was a good experience. And I'm not saying it from the point of view of it was profitable. That's always nice. But my point is it was a trade that gave us the opportunity to enter and then every week reduce risk by rolling those short options. And then we saw implied volatility rally, which allowed us to lock in an additional profit. And in the end, overall, the trade made $125 in the end, where at the beginning, if you recall how the risk graph looked like on day one when we started, it didn't look like that amazing, right? But that's the beauty of those trades, because we were relying on the earnings report to spice up the implied volatility level, and all those tweaks during every week were there to help the risk to be reduced every week in case the rise in implied volatility was not going to happen, which should, thanks to the earnings report. So let me know how you feel about this trade. Let me know if you like the double calendars and you would like me to keep doing this type of trade in the sessions, or maybe you're like, oh, this is not the type of trade I feel comfortable with, and this is why. Please share with me a little bit more about that, because certainly these trades are a bit more complex. They're also a bit lengthier in duration. I personally like them very much, combined with others. Of course, not only that in your account, but having a few of those in your account is something that I do. But again, I'd like to know more about you guys. Joe, stock tweets, more for posting tips, trades from Jose's sessions, sharing info with each other outside weekly get together. Okay. I just look at the open interest in the options volume map, and the calls are higher than the puts. So I think that traders are doing trade selling calls rather than buying puts because premium is higher due to the implied volatility. Yes, Mark, and this is what we concluded a moment ago when I did the analysis. So you are reading this correctly. Christian, you like the calendars a lot. Very nice to hear. Okay, so I'm going to get rid of WPM because this trade is over since last Friday. And now let's look at Caterpillar, which is the other trade that we have running, which is an iron condor. And it will be time to look into it and see if anything needs to be done with this particular trade. Okay, so we entered this trade. Let me go ahead and close this. So we entered this trade on that particular day when that stock was trading around 213. So 213 was more or less here. Okay. Wait a moment. That day. Okay, that day. I guess my box moved, or I moved my box by mistake. Here we go. So this is when we entered the trade, around 213. Okay, so somewhere in here, that's when the trade was entered. Okay, so since we entered the trade, the stock went from 213 to 217.85. So the stock moved a little bit. It also went a little lower, a little higher. What's important really is to look at the probability cone and compare this probability cone with the purple lines on the expiration date for this trade. So when looking at this trade, the expiration date that we're using is March 25, okay, which is right here, at the end of the purple box. So notice how probabilities suggest that price should go maximum to where the blue lines are. That's what the probability suggests, meaning that it looks like we're going to be trading within the zone where profitability takes place. If I right click and look at the risk graph. So if I graph this trade, so I can explore my break-evens. Break-even above is 232, break-even below is 187. Okay, so 187, it's below the purple line, and the one above is 232, which is more or less here. Okay, more or less here, something like that. So again, the long story short, the purple area, the way we graphed it the other day, and putting on the side, sometimes a little bit of lack of precision when it comes to where I put the lines on the chart, because in the end we use a mouse, right? Good enough. So putting that on the side, the purple area is the area of profitability set by the break-even above and below. So being above or below that zone is a problem, but at the same time, remember with the iron condors, when price goes inside this area, meaning between the red and the purple line, either above or goes below the red or the purple line, meaning below, while that's obviously not very nice to observe, the reality is that in many cases it's not a problem, because we know in these areas between the lines we have multiple red UFOs on the lower time frames, and that often brings price inside the purple zone, and we end up with a full profit. In any case, that obviously adds a little bit of risk to the trade, because it's price is getting outside of the purple zone, so we are counting on price coming towards the purple area. Okay, so this is one consideration to keep in mind. This is something that for you guys, the veterans, if you wish, the ones of you attending the sessions every week, by heart. But for the ones of you that may be newer or watching this recorded, just keep that in mind. Okay. Now, the one thing that you don't want to do though is wait for price to move, and be in that zone for you to now try to act on the iron condor to transform your iron condor into something else as a defensive measure. We are always applying trade management techniques. We are doing tweaks, we are rolling options, we are doing a series of actions in order to try to readapt to market conditions, to protect the trade, to lower the risk, to give the trade a second chance in case the market behaves in a way that is not what we expect. But if you were to wait until the price is here already, it's often way too late to act, because it went too deep into the pain area. So even though you tweak the trade now, you are not helping enough. So what we are doing is we are looking at the probability cone, okay, and we compare the probability cone with, in this case, the purple line above. We also look at it, the purple line below, but since it went higher, I'm just going to focus on the upper part. And if that cone, instead of going like that, right, the way it was, if let's say that cone was to go like this, right, and we were to see that before the expiration date, the cone is crossing the purple line, well, that tells you that based on probabilities, you may reach a zone which is beyond where those UFOs that are likely going to bring the price where you want it to be. So now probabilities are telling you that you may pass that zone altogether where the UFOs are, and that obviously it's a problem. Okay, that's a problem. So right now we don't have that. Right now, based on probabilities, the highest you will go is around 232, and the lowest you will go is around 203, which is very healthily inside the purple area, even though we still have 1 week and 1 day to go, and anything could happen. Okay, so we need to be ready to act if acting is needed. Okay, now with all of this said, which is a little bit of a summary of some of the key components in our decision-making process for management of the iron condors, which again, I'm making this little bit of a summary for the new members in the community that you guys are watching this for the first time, the second time watching this recorded, and so on. So why I'm looking at this chart and the importance of the cone, the purple area, and so on. So beyond that, I also want to make an extra observation of something that does not happen that often, that did happen this time. So if you recall, if we go back in time to when that trade was taken, I'm just going to move the probability cone. And let me click on it properly. Here we go. I'm not sure why I cannot pick the cone. Here we go. So if I move the probability cone to when the trade was taken, I think it was somewhere here. So notice what's happening. The red line, okay, the red line happens to be beyond two of the blue lines, right? So the red line is beyond two of the blue lines. And remember, the blue lines represent the historic volatility of that stock, where the red line represents the implied volatility. So when the implied volatility, the red line, is beyond the blue lines, it means that the options prices have an implied volatility built in, which is expecting the price movement of the underlying to be greater than what the underlying has been proven of capable of doing in the last 1 month, 2 months, and 3 months, which is the blue lines. And in this case, you can see that in the last month, which is the lighter blue line, the last month, the speed of movement of the stock, the volatility of the stock was greater than the implied. And this basically is because of this large move preceded by a gap, and also these large moves. Everything else that happened before, while it's pretty decent speed of movement, is basically represented by the other two blue lines, where this huge gap and so on. It's what is making the lighter line to be a bit further away. But my point is, a few days ago when we took the trade, we concluded the options are quite pricey on Caterpillar, and not only is because the rules of the trade were met, we got all of these approved for us to take the trade, but on top of that, the red line was beyond a few of the blue lines. Now look at what happened now. If we move to the current time, notice how the red line now is within, not beyond, but within all the blue lines, which means that there has been a very serious drop of implied volatility. So if we look at implied volatility, notice how volatility went from 38 to 31. So that's a pretty significant drop on implied volatility across the board for options on Caterpillar. And it's one of the reasons why, while the stock didn't stay exactly at 213, which is when we took the trade, and move up by $5 or something like that to 18, so the trade is currently making $13 per contract, knowing that the maximum this trade would make per contract is 33, which was the credit collected when I got filled on this trade, which, by the way, I got filled after the session was over last Thursday. You may recall that I was not getting filled during the session, but I said, okay, I'll try to get filled after so I can then comment and demonstrate on this trade and the management and so on. And I did get filled at 33 cents. Not sure how many of you are in this trade because, again, the liquidity was not the best. It took a while for me to get filled, almost the whole trading session. So I would anticipate or expect that most of you didn't get filled because, I really tried to get filled so I can explain how to manage the trade. So it was not the best fill at all. I only got 33. But anyway, that's what I got. So the point is, we're making $13 out of 33, which is almost half of the profit. And the way on how this profit is made is not only because of time passing, which of course that's a key variable, but also because of the shrinkage, if I could call it this way. You did not get filled, Mark. Christian, same with you. I get it. I was expecting that. I got filled at a terrible price. Okay, so I'm actually happy you did not get filled. But in any case, it's a good example for us to learn from. And so we got this shrinkage of implied volatility, which is the reason why the red line that was beyond the blue lines now is within. And therefore, while I prefer not to based on my trading style, this could be an indication for you to get out of this trade and be like, look, if volatility was to increase, okay, if the volatility was going to increase, a lot of the profits made would be given back to the market And if volatility was to increase, so now I will be approaching my upper purple line. So now I may get in trouble and I may need to start rolling and doing things. While in those tweaks and rolls, I'm not going to benefit as much, given the fact that the volatility has been shrinking. So this could be an action to evaluate what to do, and in cases actually to act on this the same way you would act, which is what I'm going to do. Okay, I'm going to emulate that this is the case. So when the probability cone crosses the upper purple line, what do you want to do? Well, the action to be taken is to take the lower puts and push them up to where the new values of the cone are, isn't it? You roll the whole thing higher to basically lock in on profits from the puts and sell puts at a higher puts of a higher strike, so you can collect more premium. So if in the end you happen to be wrong on the trade and you lose, then that extra premium is basically reducing your risk and giving you an opportunity to defend yourself more efficiently from a risk and reward point of view. So this is step one on the management of the iron condor, right? Which we normally do only when we are crossing over the purple line, either above or below. Well, guess what? Another another reason to do that could be the fact that implied volatility has shrunk. Okay? If volatility has shrunk, so you are making money beyond the speed of time decay, because you are also making money given the shrinkage of the extrinsic value in the options contracts, and therefore, an action could be taken to reassess the trade and start rolling strikes, both sides actually, the call side and the put side both, roll them closer to the midpoint of your new midpoint, which is not 213 anymore, but now is 218. So you kind of readapt the iron condor, because the fact that the implied volatility has shrinked also means that the probability of the stock to create a wider range is less. So it's a good idea to shrink those calls and puts. Okay. So again, this is a case which is relatively rare, where volatility drops very quickly. Okay, and you can see it here one more time. The drop of volatility has been very, very strong. Typically, a drop of volatility like that happens after earnings. For example, here you got earnings, okay? And look at the drop of implied volatility here. That's not a surprise because it's because of earnings. But this drop of volatility is a surprise. It's a lot of volatility drop. And therefore, the action I just defined, it's something valid as part of a trading plan and a consideration, okay? Christian, would be cool to get percent parameters that automatically alert you how much volatility drop. Yes, we'll be working at some point, Christian, on alerts for the platform, and for sure alerts on implied volatility drops and things like that. It's indeed something that we have in mind. Okay, but again, to develop an alert mechanism we don't have at this moment in time. There is a lot of work that we need to do. So we'll be considering doing that in a phase a little bit future in time, but certainly this is something that we have in mind, just like alerts for Elliott waves, alerts for UFOs, all sorts of things. I get you. And to be honest, Christian, to use that as an indication on when to do this change, I would say it would not be that useful, because in the end, you need to go revisit your risk graph to evaluate if it's useful or not. And because every stock is different, and some stocks got strike price increments of $1 at a time, other stocks $2.5 at a time, other stocks $5 at a time, some stocks are more liquid than others. Sometimes you have a skew, sometimes the puts got more implied volatility than the calls, or vice versa. So again, you gotta get there with the risk graph and do your comparison and conclude, yes, I'm doing it or not, which is what I'm gonna do now. Okay, so in the end, that indication basically would save you a little bit of time, or maybe kind of like helps you to not to miss that you have to do that. But in the end, concluding you have to do it or not implies a little bit of a manual action if you want to do it real efficiently. Okay, so let's do that. Let's evaluate. Let's bring in my risk graph, which I closed by mistake. So this is our iron condor. Okay, and now let's reevaluate. Where are we at? Okay, so if I look at where we are at on the expiration date. Okay, so I had a red line there, which is when I was planning the trade. If I was to plan the trade today, my red line would be here, which is basically the same place. So what I just said a moment ago, that when you have a volatility shrinkage like that, it makes sense to tweak both calls and puts. Well, as you can see, given the location of the upper part of the cone, and given where I had my red line before, which is basically the same location, then I'm simply not going to touch the calls, because I will end up with the same location for the call. So I'm just going to save myself a little bit of time. Now on the bottom part though, take a look that the new location for the cone is way higher compared to where the red line was when the day we planned the trade. So then for the put side, there is an opportunity to roll them up and collect additional levels of premium. So let's explore this possibility by drawing a new red line, okay, from here to here, okay, which is the current candle, the current bar on the chart, and the new location for that particular cone. With that said, let's move to the 55-minute time frame. And again, our rule needs to be met. Needs to be met, at least 2 UFOs above and below. Okay, so I guess we're gonna end this example very quickly because 2 UFOs below basically brings you to this place. Okay, so we got 1 and we got 2, which is right here, which is basically where the other one was. I remember when planning this trade where I said that given the fact that there is an overlap and the difference between 190 and 188 was very little, so basically I said let's use the one below and that's it. So well, guess what, we are in the same place. Okay, why? Because I was hoping that maybe sorry for that, that was not the right drawing, maybe somewhere here and here, maybe there were a couple of UFOs, maybe there was another UFO here, and next thing you know I can have a new purple line here, so I can take the puts which are currently here and roll them up here, and that would have been how I would have collected extra premium, rolling the puts from below to higher. But I don't have any UFO on the 55-minute time frame. Okay, so then I cannot do it on this time frame, but again I want to check a few more time frames just in case. So I'm going to look at 89, see if we have more UFOs there. Okay, so it's loading. Okay, well, not sure why it's taking so long to load. Maybe last time I loaded many bars on my chart and I forgot to change that setting. How many bars I got? 5,000. Well, that's not too bad. I'm not sure why it's taking so long. Maybe I have a little bit of a internet glitch. Let me move to a 34-minute time frame to see if this loads faster. Okay, this loads faster. And yes, so you know what? Good news. Relatively good news. So on the 34-minute time frame, I got 54% probabilities, which is 48% or more, which is what I need. And I got 1, 2, 3 UFOs. Okay, and below the first UFO below the red line is here, and that UFO it's 2 or more. So in other words, I could actually use the prior red line as the new purple line. Okay, and these may help me to bring my puts higher around 194. Okay, let me take a look at the 21-minute time frame as well. Okay, so the 21-minute time frame has many more UFOs, but same story. Below the red line, the first UFO we have is much lower. So again, the location of this purple line happens to be in that location. So let's go back to the daily time frame. So this is well understood, because often switching time frames back and forth may be a bit confusing. So the initial trade got the red line here with the purple line there. This new trade has the red line here with the new purple line here. Okay, so in other words, so now we are looking at, instead of using the 185, 187 puts, okay, which are obviously very low, we could consider selling puts below this price point, okay, which maybe 202.5 or something like that. So let's take a look at our risk graph, compare spreads, copy the primary, and the first thing I'm going to do is take the primary and emulate that I close the puts. The way I'm going to emulate that, it's using midpoint, and of course using put. I'm going to add two more legs, where one is buy and one is sell. And the one I'm going to buy is the 187.5 put, and the one I'm going to sell is the 185 put. Let me explain that. Okay, so notice how originally this trade had me buy the 185 put. So now I am reversing this at current price with sell the 185 put. And the original trade got me selling the 187.5 put, which I am now reversing by buying it back at the current price. Okay, so if I do that, basically I am emulating getting out of the trade and being left with calls only. Okay, now on top of that, now I said I'm back to this trade, and now I'm going to add two more legs. Okay, two more puts. Okay, so sell and buy, where I'm going to be looking at what if I sell the 202.5 and then I buy below the 200. Okay, so let me write this on the screen. So what if I somewhere in here sell the 202.5 put and right below buy the 200 put? Right? So I'm taking my 187.5, 185, close them, and then selling new puts higher. If I do that, what's the new trade that I got in my hands? So here's the new trade. This is a new trade where we took the original risk of 217 and the risk is now brought down to 209.5. Okay, so I will just tell you that is not gonna work. It's the difference is too tiny. Yeah, it's not good enough to justify paying, basically commissions for 4 contracts, which is gonna basically bring you to the same place. But I'm gonna explore this a bit more. I'm not saying we are giving up on this idea. So far, we by doing that, we are collecting a little bit more premium. So if we are wrong, we're gonna lose a bit less, 209. And if we are right, instead of making $33 per contract, which was the original credit collected of 33, so we are now going to make 40.5, which is the additional credit collected by rolling the puts higher. But again, the differences are tiny, and the worst part is that my lower break-even point now it's 202.22. I mean, I'm not saying this is bad, but it's much less good, and this is not proper English, but you got me. In the prior case, we had a lower break-even point of 187, which was all the way. Let me float this. That was all the way. 187 was all the way below the bottom purple line. That was, to be honest, an extremely amazing break-even point. We don't need break-even points to be that amazing. As long as the break-even points are lining up with the purple zone, that's good enough. So a break-even point of 193 would have been good enough, even though we got a break-even point of 187. So thank you very much. Right now, the break-even point we need is around 203. Okay, 203.8 is good enough. Well, we got 202.22, so that is good enough too. But the problem is that while we are getting a little bit of a tighter break-even point, good enough but tighter, the problem is that tightening, oh my God, what's happening to my English today? That tightening of the break-even point is not translating in much more premium taking in, and therefore a greater reduction of the risk or a greater enhancement of the profit is not happening. And this may be because the 202.5, the 200, they may not be the most liquid, they may not be providing the greatest amount of implied volatility. So what I'm going to do is I'm going to try what if instead of 202.5, 200, what if I did 200, 197.5. So what if I move my puts higher but $5 lower than the prior example? So let's see what happens. It's worse. Okay, it's worse. we had a risk of 217, now it becomes 215, so definitely waste of time. Okay, and therefore finally the last try is going to be, so what if I did 205, 202.5, which now I'm moving $2.50 higher. That may challenge my break-even point, we'll see, but it should give me more premium. Still, the amount of premium I collected is very poor, 208.5 instead of 217. And when it comes to the maximum profit, instead of 33.42, so it's almost the same. And my break-even point now is 204, which is above 303, 203.80. So that's not acceptable. Okay? So in other words, not good, not good. So the beauty of the volatility shrinking is that it opened the door to do what I'm doing. But I guess volatility shrinked a bit too much, okay? Or maybe instead of a volatility smile, we are facing a volatility frown. Let's take a look at the March 25 expiration. Okay, calls and puts. Let's take a look. You know what? It's going up. Okay, it's on the put side is going up here, even though I need to load more strikes. Okay, here we go. So 200, 205. So it's going higher. So it is a volatility smile, but I guess that it's not enough premium, given the shrinkage of premium that we had, is not enough premium for this to work well. Okay, sometimes, okay, not too often, but sometimes you get something like that. You got a graph that goes like this, and that's what we call a frown instead of a smile. Okay, in this case, it is a smile. It's going up. Okay, so it's a smile, but I guess the values 42 point something, it's not enough to pay us enough to justify the tweak. Okay, so then we are just gonna leave it alone and go with the flow. The trade is looking good. So, probably based on probabilities, based on the UFOs and the cone and everything else, we will end up, on March 25 expiration within the set zone, and all will be good. We'll just let the whole thing expire. No need to pay commission on the way out, and then the trade will be good if that's the case. If the market moves, and then we have to tweak. So the bad news is that at this moment in time, there is not enough premium to do a tweak that is efficient. But the good news is that if the market really moves beyond what the cone suggests, then volatility will come in. Okay, that's the beauty of those tweaks, that we don't do the tweaks unless the market really moves. Because if the market really moves, then volatility should be priced in the options, and therefore doing the tweak will help you to reduce the risk of the trade and all the way to butterflying it, which that helps a lot. So anyway, guys, I thought that was going to be a great I was excited about this, seeing the red line within the blue lines. That's an example that we have not seen too often in the sessions. I was excited about it, but hey, in the end, the pricing of the options does not justify us to complete this tweak. Okay, so we will leave it alone, and therefore I'm going to try at the speed of the light to find a new trade for today. So we are looking at implied volatility greater than 80. We are looking at high premium, and we are looking at non-directional opportunities, so nothing in the stock. Scan list, let's import the penny increment options, which, by the way, there are many opportunities that are valid without that list, okay? Neutral zone on the daily, neutral zone on the weekly. This is how we find the non-directional trades, exclude the next 15 days with earnings, and nothing with auto climate. So when doing all of this and we scan, let's see what we get. Nothing. So what if instead of 80, which is very restrictive, we look at implied volatility above the 2-standard deviation of the historic? We still got nothing. What if we look at a greater rise in the mean in the last 5 days? Here we go. Now we got 3 opportunities, and I'll take a look at NetApp. I'll start with that one and see what we have on the chart. Okay, good. So yeah, so also pretty important drop on the volatility. The red lines are between the blue. That is not so exciting. Let me float this. Let me check Pfizer. Okay, so Pfizer, we got a red line beyond the blue lines. So that is more exciting to me from that angle. So let's take a look at that. Earnings are happening all the way in May 3. So we could use expirations all the way to April 29. So all the way to April 29. Let me try to save a little bit of time by looking at the skews. So April 29. So we can use, I'll skip this one. April 1, April 8, April 29, April 22. So let me see. The option seems to be behaving quite normally. It does look like the light blue, which is April 22nd, has much less premium compared to April 29, which that is not too normal. So I'm going to ignore April 22. Okay, and therefore I'm going to focus on 4 different expiration dates. Let me load the spread builder. I'm going to float it. We are looking at building a short iron condor. Here we go. We are looking to look at March 1, 8, 14, and 29. We skip 22. We're going to be looking at minimum is 1 and maximum is going to be 2. This is a $50 stock, so maximum 2. I'm going to turn on the filters. I'm going to load my template for iron condors. That will do the work for me to approve or reject the trades. And then I'm just going to build 99. Okay, and then I'm going to sort them and see which one passes the filter. So using April 1st, we have a few that pass the filter. So let's take a look at April 1st, which is right here. And with April 1st, we are talking about 58 something and 49 something. Okay, so 58 something, 49 something. So 56, 57, 58, but that's April 8. Okay, April 8 is the first time I got 58. Okay, so that means that April 1st, we don't work. I'm not getting paid enough. So we're going to have to move to April 8. Okay, so April 8. Okay, sort. Okay, so April 8. This is the date. Sorry, here we go. So this is April 8. We are talking about 59 something, 48 something. So 59 something, that's April 8. Okay, 59 something, and then I said 48 something. So 59, 48. So the 49 is not good. 59, 40 something, that's not good. Okay, and then we are moving now into April 14. Okay, so it was close, but April 8 was not providing the premium that allow us to approve the trade based on the very restrictive rules that I have on my filtering tool here. Again, depending on trading plans, you guys may be as strict as me or more or less. Okay, and then the last ones that pass the filters are we have 3 with April 14 and 3 with April 29 or 4. So 58, 58, 57, 57. Oh, that's very disappointing. So these expiration dates, don't even surpass 59. Which is not going to work because already April 8 is pointing at 59. So April 14 is pointing at 60 or 61. Okay, so that's disappointing, and therefore, no trade on Pfizer, and we are reaching the top of the hour, so I guess we're going to have to leave it here. Let me take a look at your comment here, Christian. The tool should group Iron Condor scan parameters together, and also for the directional one. It is too easy to miss one for the other. Or off, we should write them down in our notebooks. The tool should group scan parameters together. Well, I get you. I understand where you're coming from, Christian. The thing is that there are many different ways to look at iron condors. What I share with you here in the session is based on my preferences, on my trading plan, on how I look at the markets myself. But there are other very valid ways on how to be thinking of scanning for iron condors. And yeah, so having a iron condor button on the scan would be very convenient, but at the same time, it would limit you very much. So I guess that, pros and cons. I guess that one feature that we may need to consider and release in the future maybe is, maybe here like another save button to save specific scan combinations, so you can here set up your minimums or your standard parameters that you look for or something like that. And that may be the way to solve the issue, to leave the tool to be open enough so everybody in the world can use it, so it's not limited to one type of trader only, but at the same time convenient enough as well, where you can save your preferences. So get you, Christian, totally understood and very appreciated. So we'll keep that suggestion in mind for the future. Okay, very good. Thank you, my friends. So we just reached the top of the hour. Time flies. To be honest, it's crazy how fast it goes. I join you here, I'm all excited. Say hello. Next thing you know, I'm saying goodbye. Um, uh, anyway, hopefully the session went well. You guys are enjoying the sessions. Not only with myself, also with Josip. Feel free to share with me how is it going with Josip as well. If you have any comments, he'll be happy to hear. I'll be happy to hear as well to know the good things that we do for you guys, or the things where there is room for improvement for both of us, how we complement each other, where we may not complement each other. So let me know. Sunday, I believe there is no session, Joe. You may want to check tradewithufos.com/live to check the calendar. But if I'm not mistaken, out of memory, I would say that this Sunday there was no session. So take a look. I'll take a look myself in case I'm confused, because obviously if there is a session in the schedule, you can count on me. I will be there. Wait, then you get the 70s to see how time flies. Mark, I get you, my friend. I love your sense of humor as well. But at the same time, I know you are serious with what you are saying here. So I'll take it definitely. As a very good friend of mine in Spain says, he says that just like you get a degree from a university, experience is also a degree, and therefore age is a degree. So I'll take that very seriously, Mark. Thanks for that, my friend. Everyone, a pleasure. See you soon. Keep up the good work. Keep communicating. Keep asking questions. Keep sharing thoughts, suggestions for trading, for what we do, for the tools, for everything, guys. We're here to help. Of course, the speed at which we progress and evolve is sometimes limited, because like for example, tweaking things inside the platform, believe me, it's not a joke, because the platform is very, very evolved. So you move something here and it has a cascade effect in many other places. So sometimes we need to take changes easy one at a time, where it may seem that it's easy. In the end, it's not that easy, but for sure we listen carefully, and our intention is to have the best tool, and the best tool for you guys, the best traders. Okay, so let us help you to be the best trader by supporting you from a coaching, education, and everything else, but also from a technology point of view. For sure, happy to receive your demands and suggestions and comments and everything else. So keep communicating, guys. Love it. Love you very much as well, my friends. And again, proud of you guys. Okay, I'm often receiving messages and comments that show your hard work, and also how your results are transforming, and that makes me very, very happy to see. So keep up the good work. See you soon. Bye bye, my friends.